So you guys also are now, I guess your industry or subsegment of the industry is blessed to have a lot of competition, both in other protocols pursuing the same strategy, but also in large DeFi protocols. I know Maker, Aave are now getting into the real world asset tokenization space. How have their approaches differed? And then also, what do you see on the horizon?
Yeah. So I think if you see about how securitization markets and credit markets in general work, they have been very successful because they're able to tap into insurance and pension capital as senior capital in the transaction that provides them leverage for other investors to have the appetite to underwrite and to originate assets. Now, in DeFi, in the world of blockchain, today there is not really such a thing. And we have also seen that for us to get a pension fund or an insurance fund over the line will still be like 3, 5 to 10 years from here. Now, what we see these companies like Maker and, for example, Aave doing, they're saying, hey, we have the ability to issue at a cost of capital that is almost zero against these new kind of stable coins that we're creating, where real-world assets can become actually a backbone of it. But because they are fully decentralized, they cannot actually underwrite and originate. And so we see the opportunity for them to be a replacement of that insurance and pension capital for a protocol like Credix. So very concretely, what does that mean? It means the moment that we originate assets on the network and we package them, all smart contract driven, all automated, we can sell off part of that into the protocol for the most senior secured part, and then more sophisticated investors can pick the other parts. And because it all happens on chain, we can directly integrate that and make that very transparent.
And Asiff, how are you seeing the, I guess you could call it market structure emerge around Figures products?
Yeah, look, I think the whole automated market maker or Aave or any of those things, they're super interesting. They're super interesting because they are the future. That is how a lot of financial products is going to get delivered, is going to be delivered through automated market makers and exchanges and so on. So we talked about insurance. I would tell you that there are already a number of insurance carriers who work that way. It's a decentralized protocol to which you can commit your capital. It has an underwriting model you can look at. It'll then write policy risk against that underwriting model. If it fits the box, it'll write you a policy. And you, the investor, share in the premiums and you share in the losses. Guess what they did? So they basically took Lloyd's circa 1700 and put it on blockchain, right? That's exactly how Lloyd's used to work. And you can do that for insurance, you can do that for credit underwriting, you can do that for anything. So you could take Figures underwrite model for whatever loans we do. You could create a smart contract around that. You could create an AMM that said, or a liquidity pool that said any investor out there that's accredited can invest into it, and it would underwrite loans. And that is where we're going to go. We can debate how long it takes, but that's where we're going to go. I think that's super interesting. And actually, that's a good thing, because when you guys all lived through the Circle bankruptcy, the Celsius bankruptcy and all that sort of stuff, right? It's not surprising that the centralized players failed and the decentralized players survived. You can't argue with code, right? The code basically said, you give me this collateral, if it falls below this value, I take it away from you. And that's exactly what the code did. It was the centralized players that fell over because why? You used human judgment and I had to phone the person before I did a margin call and I wasn't sure about that. No, software is super clean, right? The software is really simple. The rule is really simple. You give me collateral, if it falls below this value, I take it away from you. And when the crash happened, those decentralized protocols kept going right through it.
Yeah. It's a good point. And I guess while we're talking about the broader ecosystems that are emerging around these products, I'm curious to hear from State Street's perspective, as a traditional custodian bank, a lot of financial institutions are seeing that as an area where they're having a lot of client demand, but banks have taken very different approaches in whether they want to acquire a firm, partner with a firm, or just build out capabilities themselves. How have you guys thought about that?
Yeah, it's an interesting question. I think for us, like really both is on the table in terms of like, yeah, building versus acquiring or partnering with other, financial with other fintech companies. I think the advantages of fintech companies is that they are very nimble. They have we meet with them on a regular basis, and there are really great companies out there, and we announced I think a few out on the press with Copper, with Securrency, our partnerships recently. But it's really a difficult question. It really depends. I guess what does everybody bring to the table? Are they compatible? And can we make this relationship work? And what does it make sense? Does it make sense to partnering up with somebody? Does it make sense to acquire somebody? Does it make sense to build it in-house? So I think it really depends on what we're trying to do and what kind of area. Is it tokenization? Is it self-custody? Whatever it is. But it's definitely, I would say, both of them are in the play for us.
And Asiff, I know we've been talking about institutional products, but Coinbase, Figure, both are very retail facing. So how do you think about partnering or working with, say, back-end service providers that might make it easier for you to go to market quickly with a product?
Yeah, you have to plug into the real world, right? So when I got to Coinbase, it was not different than when I first got to Ameritrade. Ameritrade was almost 100% transactional, and we said, okay, in 3 years we're going to go to 50-50 transactional recurring, and in 5 years we'll be 70-30 the other way. And Coinbase is on that same journey, which is why when I got there, one of the first things we did was we launched a custodian. We created interest products, right? So I think given yields this year, I wouldn't be surprised if their non-trading income at Coinbase was a third or more of total income this year. Between the custodian and the USDC float that they get, there's now meaningful leverage. So all of that to say, you need to plug into the back ends. You need to plug into ACH and Fedwire and all that other stuff until it gets replaced, right? But until it gets replaced, you have to plug into it. However, what you do is you improve it. So our loans, for example, have to ultimately rely on Fedwire or ACH for funds to move. That's how fiat moves in the United States. You can't do bilateral real-time instant settlement using Fedwire or ACH, right? You can't. So what you do is you get a bunch of banks, right? Typically mid-sized regional banks, not the JP Morgans of this world, who all have a vested interest in creating more liabilities and deposits, and you get them together in a consortium. So ours is called USDF. It's a regulatory stablecoin meets the president's working group thing. They're using it for interbank settlement, and so when we generate a loan, it actually funds and settles through USDF, right? So as an investor, you send the money to the bank credits your wallet with USDF, you go to our exchange, you trade matches, it instantly moves the asset to your wallet and instantly moves the stablecoin out of your wallet to the seller, and there are no trade breaks. So go back to this whole paradigm of how do I do blockchain-based trade breaks. There is no trade break in a blockchain, okay? Let's get over it. There is not a trade break. And so it matches and settles instantly, and therefore there is no capital requirement. You're not putting escrow in. None of those things happen. So while you rely on the traditional providers like ACH and Wire and so on, just to use that as an example, you build the stablecoin layer on top of them to make them far more efficient, and eventually you will replace them.
Thomas, now that we're talking about stablecoins, a lot of DeFi protocols have sort of come out either with I just don't want to say they've officially announced stablecoins, but they've kind of announced intentions. There have been leaks. What are your thoughts on more DeFi services like backing revenues or backing any sort of flow with a stablecoin?
Yeah, so from our perspective, it's really interesting. The more this kind of flow is brought on chain, the more liquidity there is on chain, the more appetite there is for us to settle in. I think definitely also one of the next big things for our credit markets that are pretty opaque and illiquid is how do we create secondary markets? How do we create more decentralized secondary markets? So having more of these trusted assets that retail and institutions can use to settle can only just be beneficial for us.
Got it. And from
I think
here,
one thing to add,
yeah, go ahead.
we also see a demand, so we obviously do fund administrations, so we partnered up with Luca to get the number for that, but we also see a demand for decentralized, swaps, for example, like, sushi swap or pancake swaps, but like that's something as well, like we are, looking into as well, and just to figure out, like, where can we get like the sources for that? Like, there's a huge demand on like trading into these products as well. And like, again, like going back to also your point is like, we are heavily, states it is like very heavily regulated from that perspective as well. There's other things that we have to be mindful of when it comes to, I guess, like, all of these, like, I guess like regulations and things, like we have to be considerate of that as well, like, or be mindful of that as well. But like that's something we also see as well from a DeFi perspective, like, definitely, very interest, like, in a lot of interest from our clients.
So it's one of the largest pain points. So there's a bunch of funds. The one that's the most public is Apollo, that have committed to build what we call digital fund services, where you would basically take an investor, they will go through an investor subscription process, which will drop a passport on their wallet to say you're an accredited investor or a QP, et cetera, and you only have to do that once, right? All of it, I don't know about you guys, but every time I sign up to a fund, they send me like the equivalent of a foot of paperwork I got to go through, which is a pain in the ass, given that, even if it's the second fund of theirs that I'm already doing, right? So in this way, you only do it once, you get that accreditation, then you go to a marketplace that says, hey, here are all the funds that are available, right? You can subscribe, it all settles in stablecoin, and then these funds can decide if they want to run secondaries or not. Because when I was a partner at TPG or at Andreessen, one of the worst days in your life is when one of your big LPs call up and says, I need some liquidity. Because then you're dialing for dollars trying to find them a buyer, right? And so Apollo is going to have its main fund have a feeder on this blockchain-based service such that you can go through the investor subscription process, you can then invest, your interests are tokenized, and they will turn on a secondary trading window once a quarter to provide liquidity for their LPs, right? And because of that, they're the ones that are publicly announced. We have about 10 other funds right behind them that are creating this funds marketplace aimed at this investor set, right? It's just one example of how you can use blockchain in exactly that way with custody and stablecoin to do things better, faster, smarter, cheaper than our current system allows.
Really interesting, and unfortunately, I haven't yet had to experience the pain point of signing up for a fund.
Just wait.
But I want to shift a little bit to actual implementation and how your strategies have differed a bit. So, Thomas, you mentioned diving into secondary markets, and the thing that came to my mind was composability. You built on Solana, which that has been a rallying cry for them, given that they have very high throughput, are vying for a large DeFi ecosystem. What were the considerations you had when you made that decision?
Yeah, indeed. So I think what we with Credix from the beginning have decided is that we didn't want to own the full stack. So our specialization really sits at the securitization, the creation of the financial products, and then the distribution of that, and then the tooling and the framework around that to make everything work. When we looked at the core layer one, right, as they call it, the main blockchain layer that you're building upon, for us it had to have a very low cost, because we still believe that blockchain and crypto is here also for the democratization of finance, and so being able to scale that and open that up to retail later on. And of course, the throughput, the scalability of the blockchain, so looking indeed at the core layers. And then what is the activity, the developer activity around the ecosystem? Because to what you said, George, composability will be key. We with Credix, we're not looking to build everything in the ecosystem ourselves. We want to integrate, we want to be a core Lego block in the debt capital markets and then plug into that. And we found that with Solana. Does that mean that we're only going to be doing things on Solana? Probably not. The future is going to be much bigger than that. It's going to be cross-chain. But there are other smart people building cross-chain functionality that we as a Lego block will integrate with at its time.
And speaking about cross-chain, Asiff, Provenance is on Cosmos, correct?
So it's built on Cosmos.
Built on Cosmos. Yeah. That's a bit of a hybrid approach. What
Yeah.
were the trade-offs there?
So look, we looked, before we built it on that, we looked at every single chain that was available. And fundamentally, they had two issues. One was around speed and scalability, right? That'll eventually get solved. Moore's Law will solve that. The merge will solve some of that. But the second is, every single major blockchain starts with the assumption that it's the golden data store. That does not work for financial services. It will not work. It might work for a payment, it might work for an NFT, it doesn't work for financial services. You can't put 5 terabytes worth of data for securitization on chain, right? Because A, it's going to gum up the chain, and B, it's going to have PII. And so the way provenance works, like every other chain in every respect, except it's not the golden data store. What goes on chain is a hash of that loan or that file or something else. So I can, in real time, instantly tell if the thing that you claim that you're selling me is actually what I want to buy, but it doesn't gum up the works by having all of that data on chain, right? And so that's why we built it that way. It's also why companies like, Apollo and a whole bunch of banks and State Street and others have started to use it, and they are building now applications on top of it. So that's the main difference. We're not wedded to it. Like it's a Cosmos-based chain. Cosmos will evolve. Others will evolve. There'll be bridges across these chains. But this one solves uniquely a problem for financial services that others did not.
Got it. And with 5 minutes left, I want to quickly shift to some challenges that you all see for the industry moving forward. So would love to start first with Barbara and then go down the line.
I'd say the biggest challenge for us is it's when we speak to our clients, institutional investors. It's like we really need a commitment to experiment. I would say it takes time. Things takes time, and I guess also figuring out the best use cases for us. So for example, I think one of the main strategies that we see for the next years to come is tokenization, right, on private equity, private debt, real estate, fractionalization. I mean, what comes with all of that is you need to have willing participants who are willing to invest time with you, invest time in technology, figuring out what is the best use case. May it be liquidity, may it be I don't know, to make things more efficient or to reduce I don't know, certain type of risks. But I would say really have the time and the commitment to go to the journey together. I think that's the biggest thing that that we would need from our clients, and that's the biggest ask that we have for them.
Got it. And I guess as a quick follow-up, I'm curious if you see a major change in where your clients were, say, 2-3 years ago and today, and I guess not looking inward, but looking to them, what advice would you be providing them now?
Yeah, I would say definitely the conversation changed over the last 5 years. I think initially when we heard about Bitcoin and Ethereum, it was more about okay, what are these coins, what are these cryptocurrencies, what are the opportunities here, and then it quickly shifted looking actually at the underlying technology blockchain and smart contracts, and then really thinking okay, well, can we think about certain asset classes that we deal today that are very traditional, such as bank loans, public equity, corporate bonds, and how can we transform these asset classes by utilizing this new technology, and what are the opportunities there? Is it can we do something on the smart contract side? What kind of should it be an open, should it be a closed network? So it's all of these different things that we are currently exploring with clients, but it's definitely the underlying technology that really keeps them really interested in the underlying opportunities, and it moves into not only that, but also into tokenization, fractionalization, and I think for us really private on the private market side, alternative side, I think that's where we're going to see the biggest growth for the next year. I would say is private equity, private debt, real estate. It's a huge market there. The opportunities that comes with tokenization, from a liquidity, from an issuance perspective, fractionalization perspective. I think this is going to be really, really big for us.
Makes sense. Asiff, what are your thoughts?
Look, I'd say there's two, and they're related. It's regulatory clarity, number one, and two, it's getting serious about a CBDC, so central bank digital currency. So there are problems with adoption. There's problems with technology. We'll solve all those. What we cannot solve, because we're gumming ourselves up, is the regulatory mess, right? So take something super simple. Are these token securities or not? Make up your mind, right? We can go one way or the other, but not telling us is killing the industry, right? And secondly, are stablecoins, are they money market funds or are they not money market funds, right? Again, create clarity. We don't care what the clarity is, just for God's sake, create it so that we can then that we can abide by it and you can regulate it. But to sit there and say it may or may not be and then not rule, it's ridiculous. 20 years ago in financial services, we're at a point where the only way you got regulatory clarity was you either sued the regulator or the regulator sued you. And we seem to be back in that same stance, which is insanity given that what is at stake is the reference currency of Web3. And if we, the United States, don't get our act together and do something like a central bank digital currency like a US dollar, we could either do it federally or we could do it in a decentralized way through banks, it doesn't matter, but we need to do something. We are going to lose being the reference currency for that. And we are not going to be the reserve currency of the world anymore. That's what's at stake. Like a literally $1 trillion question, and our regulators are sitting on their butt, not creating clarity, right? Again, I don't care what the clarity is, just for God's sake, create it.
It's really interesting because it's also something we've seen in DeFi where, some of the protocols that are trying, you have this large spectrum where, some people are actively describing their protocols as Ponzi's, and, are getting away with it. And then some people are trying to work within securities laws, and users end up getting sort of the short end of the stick because Uniswap is the example that comes to mind, where there's this question of a fee switch, and does that turn it into a security? And the lack of knowledge sort of leaves you in limbo. But quickly, Thomas, I want to hear your thoughts.
I'll try to keep it short. We are playing emerging markets, fintech, DeFi, so we have a lot of challenges, definitely. I think regulatory clarity is definitely the biggest one that we see. Now, there it's really interesting. What we see is that it's harder for us to get that in the US than it is to get in Brazil. In Brazil, for example, the central bank is super open-minded about crypto and blockchain. We're actually setting up a tokenization working group that we with Credix will head together with Governor Roberto Campos to think about tokenized debt as a new asset class with new rulings. CBDC is huge in Brazil. They're building it, they're launching it. Banks are collaborating there, so that's super exciting. And then I think there is still a part education that we have to do. There has always been this enterprise blockchain versus crypto versus DeFi discussion, and I think it should boil back down to what we have said in the beginning. Blockchain as this infrastructure to lower the costs, to channel that cost back to the end consumer and improve the financial health and the financial wellness globally. And I think that's our task as an industry to work together on.
Awesome. Couldn't think of a better point to end on. So, Barbara, Asiff, Thomas, thank you for all joining.